right now. Rohit, good morning. Great to have you with us here. So the market has had a tremendous pullback. Last few days, not very much, but yesterday we saw an underlying buoyancy. The market refused to sell off in a big way. It refused to hold on to higher levels as well. What's your sense? Where do we go from here, Rohit?
I think the markets have made a very significant top probably last week, and my sense is that the markets are ready to fall once again, and this time around the chances are it's likely to be bigger than the last time, so you might as well call it a crash coming your way. And the crash is essentially in Nifty because actually stocks have already crashed over the last 9 months. It's just the Nifty that has been holding on. So I think the time has come for us to see that happen where the Nifty actually catches up with the broad market.
Nifty catches up with the broad market. Okay, so just wait for the crack to start. Is that the call?
The call is that the crack has already started. I think the high that we made at 6142 last week is the top, and all you're getting yesterday and probably today may be a minor bounce back to that decline. And once you get that minor bounce back, probably to 6000, 6030 max, then we should be headed in the next leg down over the next 10-15 days to 5600, and over the next month or two to much below the 5100 level.
Okay, I'll come back with more in just a bit, Rohit. Both of you think a correction is overdue. So let me take the other side of the argument and let me give the liquidity argument for a bit, Rohit. First to you. So what's, if all this printing is to go on without any end in sight, very simple. I mean, it's no rocket science. That means that there's ample liquidity for an extended period of time, which means that it will continue to chase yield. And things like stocks and emerging markets, like India. Very simple counter argument. How do you respond to that?
Very simply, that argument hasn't worked for the last 1 year. So if something has not worked, you have to really look into why it didn't work. There's a very old market saying, and it says that markets fall on their own weight. So just the existence of liquidity is probably not a sufficient argument. Liquidity is always high at the top, low at the bottom. The real issue is not liquidity. The real issue is the macro picture, which is slowly turning to the downside. I think the main market which has actually been holding up during this time period has been the US market and probably the German market. These are two markets that have actually done better than most others. All the Asian markets have actually fallen during the last quarter. And have only retraced 61% of the fall that you saw in the last quarter during the last 2 months. And India probably in that sense was the best performer in this time period because the Nifty came back to the 6000 level, which none of the other Asian markets or emerging markets have been able to do. So that given, the only market that really performed over the last year was the US, and the US now has what we call an ending structure over the last couple of months, an ending diagonal, something which occurs only when a trend comes to an end. So I think the biggest risk now comes from the US itself, which has been the source of liquidity. And since liquidity stopped working on most emerging markets, the only place it's working on is the US itself. And that will come into question not just with tapering, which is postponed, but with also the debt ceiling limit debate, which has just started.
You said that it has not worked for the last 1 year. The Nifty is at 6,000, Rohit. Why do you say it has not worked?
It has not worked because number one, your mid-cap index is down 30% even today. Your BSE 500 has not made new highs even as the Nifty has made. And we got a recent very good intermarket divergence which is between the Sensex and Nifty itself. The Sensex made a 52-week high just a week ago, which was not made by the Nifty. These kind of divergences only occur when you're making medium to longer term tops. They don't occur otherwise. And so it's a very important thing to note that it has happened. The coming back of Nifty on the back of one particular sector might not be the right way to look at liquidity working.
Yeah, I mean, that's true, but I don't know if that is evidence that I mean, all this money printing is not going to chase everything. it'll chase selectively, and you got the Nifty, which is which has rallied to 6,000 multiple times. I mean, you know, we've been in this range for a very long time, so you can argue saying that it's not really taken us higher in that sense. It's led to severe bouts, 1,000-point swings many times over. But mid cap, small caps, I mean, they've been down in the dumps for a very long time now. QE, no QE. I mean, it started in 2000. Rohit, you want to sort of come in? So I get your point on the US market stopping, and you write this morning that the action may shift from local to global because of what you see in the S&P 500 index. But just on that QE point and the printing point, what's your sense?
Look at one more factor. You have bond yields in the US if you're tracking them over the last 1 year. And again, if you look at a chart which is at least 10 years long, bond yields completed an ending structure which is almost 10 years long and started to rise. And as they did, I think this is the first significant rise that you have seen breaking out of several 5 to 10 year trend lines in the bond yields for the US. So this is being seen as a major reversal in the bond market rally that has been around for very, very long. Some are already calling it the bond market bust, which may not get recognized till it enters what we call the third wave. So you're getting some cooling off in that. I think US bond yields, which have hit 2.9%, could cool back to maybe 2.2, 2.3% over the next month or two. But at some point down the line, you're going to see those yields go even higher than where they are today. So that has become the first indicator that liquidity is not working, to answer the question on liquidity. So it stopped working on the bond market irrespective of the $90 billion that they are buying every month.
No, so the point is that it might start working again. I mean, it worked for a while, and then across the board you had yields which jumped as there was indication that taper will happen, taper, right? But it's not happened.
No, the tapering news is relatively new to the bond cycle, because if you look at the bonds, they actually bottomed in the bond yields bottomed somewhere in Jan to Feb of this year. The tapering news is just 2 months old. So the news came in at the fag end of the yield jump that we saw, and therefore is being related to that. And actually the two are not related. It's actually that the bond markets could not stopped working on liquidity by themselves, and I think that caused the Fed itself to panic. But at the same time, they just didn't have it to take a decision to taper because they were too scared of what might happen next. But the markets are themselves deciding that the weight of, like I said, markets fall on their own weight, and that has already started happening in the US bond markets.
Okay, no, got that. I just want to, I just sort of pulled up the Citi report, and we'll put details out in a bit. So this is basically an explanation for what the Federal Reserve did last week on Wednesday when they did not taper. So they write, and I quote, "In addition, as far as we are concerned, Chairman Bernanke at the press conference looked like the cat got the cheese, despite the more downbeat message he was giving. Why? Because he got his way. Once again, an attempt to end QE had failed. His right-hand woman was now taking control of the Fed. The doves had once again taken firm control. Policy Hotel California, you can check out anytime you like, but you can't never leave, was firmly in place." And they go on to conclude, "If we are correct in this conspiracy theory interpretation, it is likely that Janet Yellen's nomination will indeed be announced in the near future, and that tapering is now firmly off the table, despite the guidance given in recent months to the contrary. As always, time will tell," as we speak. Rohit, so let's just look at our market here, and why don't you put out some trades that you really believe in, if you want to, from a near to medium term perspective.
Absolutely. I think it's the time to start building shorts. The stocks that I'm looking at are essentially private sector banks again, those which were battered the most and have bounced back most sharply. All of them have retraced 50 to 60%. Axis Bank, Yes Bank, ICICI Bank, all of them would be short targets. Then we would also look at metals. These are leading on the way down. They've started falling a little early. And you're already seeing weakness in the CRB index and metal prices. So I think metal stocks are leading in that sense. Tisco and Hindalco would be sells. And then I would look at the auto stocks. The auto stocks have been among the outperforming sector of the last quarter. Even as we saw weakness in most interest rate sensitives. And I think Tata Motors and Bajaj Auto should be again topping out and heading much lower.
I almost sense, and I know I'm using the word consensus loosely. So when I say consensus, is about 10 or 12 people that I've spoken to and I've heard views of. There almost seems to be a consensus, Rohit, emerging that the market is poised for a correction. It's going to drop. Is it because of the unbelievable move back, which has been so fast? Which has taken the Nifty back to 6,000, and people are still getting their head around that, justifying that move and saying, well, this is just thin air. It has got to come down. So what we saw the week before last was the real deal, and this is just thin air. This move up. Is that the reason why people are unable to reconcile to the fact that the market has pulled back so strongly, and just that it might head higher? I'm not saying it will, but what's your sense?
Okay, there are two arguments in this. The first one is that we were in an extreme oversold condition, and we discussed it when we were 53, for which we were looking for a sharp move up, which actually happened. Which happened because the market was extremely oversold on negative sentiment. Everyone had given up on the market. Now that this sharp move has come, the number of people who are looking for the market to head down, like you said, are mostly looking for a correction. And where I am differing is that I'm not saying this is a correction. I'm saying it's going to be a crash, because you're going to go far lower than where you actually started. The thing is that the sharp bounce back has essentially come on an extreme of negativity and sentiment. Like you said, it might be on thin air. Yes, it is on thin air, because the broad market, which I was looking at to confirm that this move is for real, really did not participate. When the Nifty comes back to 6,000, do I see stocks across the board going up? That didn't happen. And if that didn't happen, that means the market is full of thin air, and it's likely to head down all the way again.
Rohit, thanks very much for your time. Great to have you with us here as always, SV. Just last thoughts.